Please remember, none of this is financial advice. I am not a financial advisor. Welcome to the Higher for Longer podcast. My name is Mason, and today we will be discussing the Blockworks Macro podcast titled The US Dollar Wrecking Ball in a China Shop, featuring Michael Kao and Nick Glinsman. This is the On the Margin podcast presented by Mike Ippolito. This is one of my favorite podcasts to watch, and Mike always has very insightful guests. So let's get on to my notes and breakdown. Alright, so this was a very interesting interview. It was full of knowledge and information. Michael and Nick are both very interesting to listen to. They're both very insightful. I will link their Twitter accounts and put them up on screen. Alright, so at the beginning, China appears to be in decline. They go through a bunch of charts for this. I definitely recommend that you check the video out for yourself. The information these guys have is insanely insightful, and it's very into the nitty-gritty of the Chinese economy, and as far as I'm concerned, that's not really data that means a lot to me. It's very important for us to know what is going on in China, but taking their word for it is good enough for me personally. I'm not moving the kind of money these guys are. I just want to know what is happening over there, and they paint quite a picture that shows that it's not looking too good over there. So that's kind of all that I'm really taking away from that whole first section. Now onto the things that I personally find more appealing to my own investment strategy. They begin talking about the long end of the yield curve here in the United States. They talk about how the long end is increasing in yield. Nick then goes on to talk about how it's mostly pension funds that are buying the longer end of the yield curve. Domestic buyers will remain the main source of buying, Nick continues to say. And he also goes on to say that it is unlikely that the Treasury is building a fund to buy back debt, and why that is important to us. And that's something that I did take a note of, and it kind of caught me out, is because if that were to ever happen, and Nick makes a good point that this would not be something that would happen quietly, but if this were to happen, that is the United States government buying its own debt, and that is a huge problem. That would likely lead to a hit to the currency, and that is something that would affect us here in the United States. But again, Nick said that it is unlikely that that is taking place. Now moving away from Nick and moving into Michael's thoughts, Michael makes the case for a continued bear steepening. A bear steepener is where the long end of the yield curve is raising in yield. So as we've seen the 10-year and the 30-year begin to go up, that is a bear steepening. A bull steepening would be when the Federal Reserve is cutting the short end. So the 3-month, the 2-year, when those rates are being lowered by the Federal Reserve, that is a bull steepening. A bull steepening is obviously what would lead to something like a bull market, where we would see yields begin to drop and risk assets begin to move upwards. And unfortunately, we are not currently experiencing the bull steepener. We are experiencing the bear steepener. And the current little rise in asset prices is something that I think is interesting to watch as this situation develops. Another point that comes up that took me by surprise was that per the Congressional Budget Office, we are expecting to run a $2 trillion deficit per year for the next 10 years here in the United States. And that took me by surprise, because how can we afford that? That is so much debt that is going to have to be financed at these high rates. That is something to me that just, it really blows my mind when you really wrap your head around $2 trillion a year for the next 10 years. That's $20 trillion in deficit, and that's just the projection. That is not actually what could take place. The actual number could end up being higher than that 20 trillion, and that is a huge amount. But back to the topics at hand, Michael Kao then predicts that the Federal Reserve will win its inflation fight here in the United States, and that will come by one of two things. He says that the Fed will either break the U.S. labor market, meaning people will lose their jobs, or the slowdown and collapse in China could be a large deflationary impact on the global economy. And now the really bold take, and the one standout that I took away from this interview personally, is when Nick makes the prediction for a sovereign debt jubilee. Now, what that means is that sovereign debt could just theoretically disappear. The thought of sovereign debt just being wiped away is absolutely crazy to think about, and thinking about the impact that would have on currency and markets. Nick goes on to say that this would most likely be tested in Japan or England. And now we'll move into the segment where Michael asks these guys to give their own predictions of what they see most likely to come in the future. Michael again says that he is not expecting a soft landing. He's also currently watching the price of oil and risk assets here in the States. He seems to believe that these will be the likely indicators to show that we are experiencing the economic pain and slow growth that is consistent with a recession. He also again makes a case that he believes China is already beginning to fail. The reason that is important is because of the large deflationary pressure that China failing would put on the global economy. Now on to Nick's approach, which is a little bit different. Nick is watching the US Treasury markets. He believes that higher yields for longer will continue to lead to the strong dollar, which will then break other countries, starting with emerging markets. As far as the Treasury goes, we have Jerome Powell speaking at Jackson Hole, as well as Christine Lagarde coming up. I know Powell speaks on Friday, and that is important because he is very likely to have some sort of effect on markets in his speech. If he continues to stay higher for longer, while Lagarde is more dovish in stance, that could likely cause some problems in those markets. And now all my takeaways from all those notes. It's a lot to take in for sure, but both of these guys are insanely smart, and I definitely again recommend that you go watch the video. I'll have it linked in the description. But they definitely give some indicators that we can watch. We know we can watch the Treasury market. We know we can watch any news coming from China, because both of those will be important to global events. Also watching currencies, especially the DXY. It will be very important to watch the dollar, because a strong dollar obviously leads to flows out of riskier assets, because those dollars are likely being used to buy things like treasuries, which are the global risk-free asset. So if we see a strong dollar, that will likely lead to tough times in the global economy. A strong dollar, that's why this is titled The Dollar Wrecking Ball, is a weight on global trade and the global economy. These guys both seemed pretty convinced that we are likely to see hard times ahead, and that is worth noting because those hard times can lead to great buying opportunities if you're looking in the right places. That's just my opinion though, but it is an opinion that I am likely to act on. A lot of what these guys talked about are things that I personally track in my own metrics, my own models, and my own research, and I will be looking to make those available soon. So please, if you enjoyed this, give me a like or a subscribe. I would greatly appreciate it. I look forward to reading the comments and seeing what you guys think of this work. If you think that my opinions are way off base, I would love to hear it. I look forward to talking with you all in the comments, and I look forward to growing this community. Thank you for listening. Have a good day.